Everyone, Joe Gentili from Left Tail Risk Advisors. So in this video, I just want to go through some of the principles that we have in mind when thinking about insurance planning, when thinking about litigation around insurance, and just what animates how we view risk. And some of these principles come from Nassim Taleb, who is a prominent author on risk and risk taking. And I think that a lot of the ideas he's put out into the public or popularized have really been game changing and have certainly influenced me a lot. And so I'm not going to go so much into specific planning with life insurance or other types of insurance in this video, but just more first principles. So first, and this is an idea populated by Taleb in the Black Swan, is that events in life are driven by rare events disproportionately rather than the common ones. So if you look at that into the, um, let's say, just world events type view, the course of history is charted by the rare events that occur that nobody sees coming or could predict. So, for instance, 9/11 would be an example of that, and how a rare event like that just changed the course of world history, changed the course of the United States in ways that weren't predictable beforehand. And the same thing happens on the personal level. The type of things that really change the course of a person's life could be a disability, it could be the sudden death of somebody around them, it could be a tremendous financial setback, things like that. Those events tend to move where our life goes much more than kind of things that happen ordinarily. Most experts don't know their subjects, or especially if you're talking in the world of prediction, as well as they seem to or as they present. And so, where this comes into play is where you have folks that are predicting where the economy is going in the short term or long term, how world events or wars are going to shake out, what the real estate market is going to do, all manner of prediction oriented experts generally are not nearly as good as they frame themselves to be. And that's pretty easy to see because if you just take a look at predictions people make 5 years ago, 10 years ago, as to all these things and see how often they played out to be true, you'll probably find that the odds of these predictions coming true are not much better than flipping a coin. Um, there's certain things that are very suitable to experts talking on things for which, like, physics, hard sciences, very, very expert dominated, and you could rely on them. But when you get into the world of economics and you get into what the world of investments and finance, predictions are much less valuable. Next, you want to avoid ruin risk at all costs. So there are setbacks that you could come back from in life. There are things that are recoverable. There's losses that you could take that are small. But what you really want to avoid is the type of catastrophic loss that wipes you out and wipes out the opportunity to get back in the game. So it just kind of reminds me of that old adage to never bet what you can't afford to lose. So that's something to keep in mind as well. And there's a lot of folks that orient their financial life towards, let's say, taking bets that have small gains most of the time, the vast majority of the time, but it's a type of bet that every once in a while, if it doesn't work out, you can get wiped out. And this happens a lot, particularly with leverage. When you introduce leverage into a situation, there's a lot of scenarios where it works out most of the time, but when it doesn't work out, it really doesn't work out. So you want to avoid that type of risk. I'd say another version of that is what people would refer to as self-insurance. There's certain things that are totally appropriate to self-insure. So for instance, you buy a piece of electronics, it's a $500 investment, and you don't buy the warranty. Effectively, what you're doing is self-insuring. And that makes complete sense because worst case scenario, if you lose the electronic or it breaks, for most people, $500 is not a ruin risk. But on the other hand, if they are not insuring against the risk of becoming disabled, for instance, and that does come to pass and they lose their ability to earn a living, a whole different level of risk. Um, Related to these things, how you protect yourself is you want to build systems that don't rely on prediction, but they rely on building out robustness in the event bad things happen, even if you can't predict exactly what the bad event is. So if your system of risk management revolves around correctly predicting the future, that's a problem because, as you know, we went through before, even predicting, even experts trying to predict the future, where the stock market is going, where the real estate market is going, for instance, it's really a fool's errand. It's not really possible to do with any ability that you should actually rely on it. Instead, what you want to do is you want to build yourself out such that regardless of what comes to pass, you're going to be okay. And that comes from diversification, that comes through insurance, that comes from not over concentrating in any one thing, you know, again, a version of um, diversification. So you just really want to make sure that you're going to be okay no matter what happens, as opposed to trying to predict exactly what will happen. All of this, another way to look at that is you want to have, this is according to Taleb again, his way of approaching that is through what he calls a barbell approach. And the barbell approach is you want to have things that are very much on the conservative, low risk side of the spectrum. You want to have most of your assets there, and then you want to have some of your assets, a small amount, in the type of assets that have very high optionality, where the downside risk to them, um, the downside risk may be low, but they have huge upside. You don't want to have too many eggs in this because it doesn't always work out, and don't be swayed by success stories with that because there's always the story of somebody that put 100% of their money into crypto or a startup or something like that, fully concentrated in something, very low percentage chance to work, and it actually did work, and they're fabulously wealthy as a result. Those things do happen, but they're very, very rare, and you shouldn't bet on that. What Taleb suggests doing, and I think it makes sense for most people, is he has the vast majority, or he suggests having the vast majority of your assets in very low risk investments, treasury bills, insurance contracts, things of that nature. And then having 10, 20% of your assets, or or depending on how wealthy you are, maybe you could have more if you have enough money that no matter what happens to this riskier side of it, you're okay. But then just having some of your assets going to shooting for the stars, that, you know, it's investing in the startup or that business, or types of equities that have really, really high upside potential, but don't carry the risk of ruin with them either. So that's how he suggests setting up things. And I think it makes sense because what it makes you is it makes you robust. And to use another phrase that he has is anti-fragile, that you could benefit from low probability events in that scenario. That if the world goes to hell, you'll be okay because most of your money is going to be invested in very safe assets and you'll be able to ride it out. But if those low event thing happens, the drug company you invested in has a major breakthrough and the stock goes through the roof, you're going to benefit from that outlier event as well. So these are just some of the principles that I have in mind and we have in mind when we're thinking about how to orient our advice around insurance and how to use insurance to protect yourself from having a rare event in life just dominate your life story in a negative way, about how to avoid the risk of ruin in a lot of situations, which is what insurance is meant for. And there's a lot of different ways it does that. And to provide a robustness and to provide assets that are very low risk and very reliable, such that it enables you to take more risk with other assets, which over time should give you both the safety of knowing that you're going to be okay no matter what, but then also allow you to chase more risk with those assets that you're putting at risk and hopefully benefit more. So this is just some of the thinking that goes behind our advice, and I thought it'd be helpful to share that. So if you have any questions on this, as always, please feel free to reach out. I hope this video was helpful, and if it was, I encourage you to like and subscribe. Thanks.